Good morning dear students. Yesterday I discussed with you topic capital structure. Once again I am going to revise the same topic. What is the meaning of capital structure? Students, capital structure is a proportion of debt and equity used to finance various operations of business. In business we can use debt as well as equity. Yesterday, I finished my lecture with a question that why, with the use of debt with equity, income of equity shareholders increases. So today I am going to give you answer of this question. Students, with the use of debt with the equity, income of equity shareholders increases only in that situation when rate of interest on debt is lower than return on investment. Once again, I am speaking the same situation only when rate of interest on debt is lower than return on investment. Now you will ask, what is this return on investment? Return on investment is the percentage of earning on amount invested in a company. So here the question I discussed yesterday with you, I am going to find out return on investment. Be focused on the board. So students, now I am going to calculate ROI, return on investment. The formula is EBIT, earning before interest and tax, upon total capital employed into 100. So students, in the yesterday's situation, we were having EBIT of rupees 4 lakh. I have taken the same 4 lakh divided by total capital employed was 30 lakh into 100. So I calculated return on investment at the rate of 13.33%. Now think, what was the rate of interest yesterday? Yes, it was 10%. So see, rate of interest is lower than return on investment. Rate of interest is 10%, which is lower than 13.33%. So that's why, as rate of interest is lower than return on investment, that's why EPS is rising, earning per share is rising, and this situation is called as favorable financial leverage. So I think you all are understood why, in which situation with the equity, if a firm is using that also, why income of equity shareholders increases. So students, we have one more term, that is trading on equity. What is the meaning of trading on equity? Trading on equity refers to that situation in which profits of equity shareholders increases with the use of fixed financial charges, that is interest. I am repeating, trading on equity is a situation when profits of equity shareholders increases with the use of fixed financial charges. What is fixed financial charges? Interest on debt is fixed financial charges because it has to be paid by the company in every situation. And why fixed financial charges arises? When a company has issued debt or a company has taken loan. So you can form one more definition of trading on equity. Trading on equity refers to that situation when profits of equity shareholders increases because of use of debt with equity. When a company is using debt with equity, because of using debt with equity, if profit of equity shareholders rises, that situation is called as trading on equity. Think about the yesterday's example. In the yesterday's example, I gave you three situations. In the first situation, company X was using only debt. In first situation, company X was using only equity. There was not any debt. It means that was not the situation of trading on equity. In second situation, company was using debt of 10 lakh with equity. So that was the situation of trading on equity. And in the third situation also, company was using debt with the equity. So that was also the situation of trading on equity. When a company is using debt with equity, because of which profits of equity shareholders increases, that situation is called as trading on equity. So students, now I am going to discuss one more example with you people. So be focused on the question. See, company Y Limited has total capital employed of rupees 30 lakh. Tax rate is 30%. EBIT of this company Y is rupees 2 lakh. Again, there are three situations. First is when company has not issued any debt, means company has not taken any loan. Second situation, when there is a debt of rupees 10 lakh at 10% per annum interest rate. In third situation, debt of rupees 20 lakh at 10% per annum interest rate. Now I am going to start EBIT and EPS analysis. So first of all, what you will take? You will take EBIT. So I have written here EBIT rupees 2 lakh in all the situations. Now as you know, first of all I have to deduct interest. So in situation 1, when there is no debt, so no interest will be paid. So nothing is to be written here. In situation 2nd, there is a debt of rupees 10 lakh. So 10% interest. 10% of 10 lakh will be 1 lakh. So I am deducting 1 lakh rupees from the profits, earnings. In third situation, we are having debt of 20 lakh. So 10% of 20 lakh is 2 lakh. So that's why I am deducting 2 lakh from the earning of 2 lakh. Okay, now then I will get nil balance because 2 lakh are deducted from 2 lakh. In this case I am getting 1 lakh balance, and in this case I am getting 2 lakh. So from EBIT interest is deducted, so I am getting EBT, earning before tax. Now from earning before tax I have to deduct tax at the rate of 30%. So now 30% will be calculated on the earning because tax has to be paid on the earning. So in first situation, earning is of rupees 2 lakh. So 30% of 2 lakh is 60,000. In second situation, earning is of 1 lakh. So 30% of 1 lakh is 30,000. In third situation, there is no earning, so no tax. After deducting tax from earning before tax, I am getting earning after tax. In first situation it is 1,40,000. In second situation it is 70,000. Now student, I have to calculate number of equity shares. Formula is total equity capital divided by price of one share. So price of one share is rupees 10. And in first situation, company has not issued any debt. So total capital is equity share capital. So total capital is 30 lakh divided by 10. I am getting 3 lakh equity shares. In second situation, 10 lakh was debt. It means equity share capital is of 20 lakh. Divide it by 10. I am getting 2 lakh shares. In third situation, 20 lakh was debt. So equity is only 10 lakh. Divide it by 10. I am getting 1 lakh equity shares. Now students, we have to calculate earning per share. Formula is earning after tax divided by number of equity shares. So in first situation, earning after tax is 1,40,000. Divide it by number of shares, that is 3 lakh. So 1,40,000 divided by 3 lakh, I am getting EPS of 0.47 rupees. In second situation, earning after tax is 70,000. Divide it by number of shares 2 lakh. I am getting EPS of 0.35 rupees. And in third situation, there will be no EPS because there is no earning. So students, what you observed in first situation, when company was not using any debt, in that situation EPS is 0.47 And in second situation, when company is using debt with equity, EPS is decreasing. It is 0.35. So what we come to know here? We come to know that EPS is decreasing even by using debt with equity. Why this is happening? There is one and only reason, that in this case ROI is less than interest on debt. That's why EPS is decreasing. So let's calculate the ROI. ROI is equal to EBIT upon total capital into 100. So in this case EBIT is 2 lakh. Divide it by total capital, that is 30 lakh into 100. I calculated ROI 6.67%, which is less than the rate of interest. Rate of interest is 10%. So that's why with the use of debt with equity, EPS is decreasing. So whenever we have to take any decision whether we should use debt with equity or not, we should calculate ROI. If our ROI is more than the interest on debt, only then debt should be used with equity. In yesterday's example of company X, ROI was greater than interest on debt. That's why EPS was increasing again and again with the increase in the amount of debt with the equity. Now you can have one more question, that we should increase more and more debt in every situation with equity. No, you should use debt up to a limit only. It should not be used up to unlimited limit, because with the use of debt our financial risk increases. We will not be able to pay high interest if we are using debt more than the limit, because as you all know debt is the most risky source of finance. So we should use it up to a limit with the equity. So here student, the topic of capital structure as well as trading on equity is over. I hope it is clear to all. Even then if you have any doubt, discuss with me. Thanks class.